Okay, so today we'll be doing question 2 in the 2018 question paper, Fundamentals of Accounting. Yesterday we did question 1 on the ratios. So today we are going to do question 2 on the inventory valuations. So you are given okay, sorry guys. So we continue. You are given a list of all purchases made and the units that were sold during the year. And it says that Jumani Pet Store in Capeman sells pet good. The store uses periodic inventory system, and during the year, the store had the following records. So you have the receipts and the sales made during the year with different months. So you are required to evaluate the cost of inventory after every transaction using the following methods: first in, first out, and average cost method. So when calculating your cost of sales using these methods, you draw up a table. So we draw up a table. Let me quickly just finish drawing up this table. Okay, so we have the date, the receipts, or in other words, bought. So whatever word you write, and then you have the sales or issued. Ne? And then you have your balance and then the total. Okay, meaning that whatever items that you buy, you will record them under the receipts, and all the sales you make, you record them under sales. Please take note of that. We do not use selling prices. We do not use selling prices in valuing inventory. So what does this mean? We can see that we have sales here, but we do, and we are given sales amount, but that does not mean that we have to record or to use our sales amount when it comes to inventory valuation. So we only use our cost. Ne? So we are starting off with FIFO first. We are starting off with FIFO, which is first in, first out. We are starting off with FIFO first, which is first in, first out. So with first in, first out, it says that the inventory that came into the business first will be sold out first. For instance, if you bought stock yesterday and then you bought another stock today, you will first have to sell out the stock for yesterday because that's the one that came in first. Then once it's done, you move on to the stock that you bought today. Meaning that if currently we are in October, so if you had stock that belongs to September, which is unsold, that was bought in September, before you start selling your October stock, before you start selling the stock that you bought in October, you first need to sell out the September stock. That is first in, first out, meaning the stock that came in first should be sold out first. Please just mute yourself because I'm recording this video, and if you have a question, you are welcome to unmute yourself and ask. Okay, so what did I do again? Okay, so using the information that you are given, let's calculate our closing stock. So the first one, we are told to calculate closing stock using our FIFO. Okay, so we start off with January, and before that, before you start recording, you should always make sure if you are given a balance, ne? For instance, you are given a balance, you're told that okay, in January we had stock on hand of maybe 20 items at the price of $50. That is now the balance. Then what you will need to do is you record January, for instance, like this, January the first, because balance brought down is always on the first, and then under the balance, that's where you record 20 items at maybe $10 each, ne? That only if you are given the balance. But if you are not given the balance, and then you record the total here, which is now in this case 200. But this only happens when you are given the balance brought down. But then if you are not given the balance brought down, so you start recording already. So let's start recording with the information that you are not given, that we are given. You can see that we were not given any balance. So we're not told of any balance on hand. So what we do is we start off with January. So it was January the 1st. January the 1st, what did we do? In January we bought. So we are going month by month, ne? So in January we bought how many units? We bought 100 units at the price of 50. So under the receipts column, you write 100 at you write 100 at the price of 50, like that. And then did you issue out anything? No, so it's 0. And then you go to your balance. Now, what is my balance? What do I currently have in stock? You only have 100 units at 50, so you record 100 units at $50 each. So what is my total? What is my total value? So you take your 100, meaning you have 100 units and each unit is $50. That's what it means, 100 at 50. So you take your 100 units, then you multiply it with 50 to find your total value, which is 5,000. So your stock is valued at 5,000 currently. I hope we all understand. And then we move on to the next month. From January, it's February. So what did we do in February? What we did in February is that we sold 40 units, ne? And we said we do not deal with the selling prices, so we leave them behind. We do not use the selling prices, ne? So we bought 40 units. So in February the 20th, you record the date, February the 20th. What did you do? We did not buy anything, so it's 0. However, we sold. So how many units did you sell? You sold 40 units. So now the first in first out says that You first sell out the inventory that came in first. Now looking at you have to look at your balance, ne? Now you're looking at your balance. In this case, you only have one balance, right? In this case, you only have one balance. So you are issuing the 40 coming from this 100. So the 40 that you sold came from your balance that you have, came from your inventory that you currently have on hand. So you will have to issue them according. Yes, is there a question? Okay. So using you have to issue the 40 using the cost price of this 100 units, because that is the only stock that you currently have on hand. So it will be 40 at $50. Okay. And then from there, what is your new balance? What is left? Ne? Now, what is left in your business? You had 100 units, then you sold 40 units, so you are only left with 60 units. You are only left with 60 units at the price of 50. So what is our new total? So 60 multiplied by 50 will give you 3,000. So currently our stock is valued at 3,000. And then we move on to the next month. From February, we go to March. Okay, so what did we do in March? March the 10th. What did we do in March? We bought 100 units at the price of $60. So you record we bought 100 units. Oh, sorry, 120 units. At what price? At the price of 60. You understand? 100 units at the price of 60. So did we sell out anything? No. Then we go on to our balance. Now what do? The first thing that you need to do is you need to bring down the balance from the previous month. You need to bring down the balance from the previous month. So in this case, you have 60. Ne? So you bring down your 60 at the price of 50. And then from there, that's when you record your new balance. That's when you record your new balance or your new stock that came into the business. So you will have 120 at the price of $60. Oh Lord. I'll get back to you. I'm quickly getting class now. So you have 120 at the price of $60. So this is our total balance that we currently have. First thing you need to do is you have to bring down the balance from the previous month, and then you record the new balance that you bought or the new inventory that you bought. Okay, and then we find our new total value. So 60 times 50 is already 3,000. So 120 times 60 will give us 7,200. So 7,200 plus the 3,000, that of the one of 60 at 50, will give us 10,200. So our total value is 10,500. I hope we all understand. Okay, and then we move on to our next month. We move on to our next month, which is October, the 10th, our next month. So from March, the next month is obviously October. January, February, March, April, May, June, July, August, September. It's October. So October the 10th, What did we do in October the 10th? What we did is we sold 60 units. So we did not buy anything, and that's why it's zero. Now we go to the issued or sales. We bought 60 units. So the rule says first in, first out. What came in first should be sold out first. So looking at this balance, what came in first? Looking at this balance, what came in first? Obviously, the 60 is the one that came in first, the one that came in January. So the 60 is the one that you should issue out first because that's what came in first. You understand? So you have 60 at the price of 50. And in total, you are told that you sold 60 units in total. You sold 60 units in total. So what will be your new balance? Now that you sold out this 60 already, your new balance, our remaining balance will only be 120 at the price of $60. I hope we all understand. And then our new, just hold on, 120 times 60. Sorry, this was not, it's not 10,500, but it's actually 10,200. Okay, now what is our new total value? 120, you multiply with it with 60, then it will give you 7,200 as our new total cost. Okay, and then we move on to the next month. So the next month is November. What did we do in November the 12th? November the 12th. So what did we do in November the 12th? We did not buy, but we sold. So how many units did we sell? We sold 20 units. Now we sold 20 units. So meaning that this is the only balance that we currently have. In October, we only had a balance of 120. So basically the 20 will come from this balance because that's the only balance that we have in stock. So you have 20 at the price of $60. At the price of 60. So, and that will give you what will be our new balance. What is left in the business? So 120 minus 100, we only have 100 at 60 remaining. So our new or our closing stock that we are looking for will be 6,000, and that is the stock that we are looking for. Okay, so are there any questions? Please, if you have any questions, so this is the closing stock that we were asked to calculate using FIFO. So if there are any questions, please just unmute yourself and ask. 2 minutes to ask questions if you have any questions, or if I was a bit fast somewhere, or yeah, please just unmute yourself and ask. Any questions before we move on to AVCO? So if you guys are mute, then obviously that will tell me that you understood and I should move on. Okay, I see there are no questions, so we move on. That was A. So B, you are asked to calculate your closing stock or to value your stock using your average cost method, in other words, using AVCO. That is 2.2. Using AVCO. Okay. Now calculate using AVCO. We draw up the same graph. Using AVCO, we draw up the same graph or the same table. Let me quickly just draw up the table. Oh, what am I doing? Draw the same table. Okay, so you have the date, you have the bought, okay, bought, and then you have issued, and then you have balance, and then you have the total. Okay, now AVCO, this simply means that when you are issuing when you are issuing when you are selling your stock, you need to value the stock according to the weighted average, according to their average cost, meaning that we weigh our stock using their average cost and not their cost price. We use, when it comes to alcohol, we value our stock using their average cost and not their not their cost, ne? Not their buying price. Okay, so how do we calculate our average cost? So average cost equals to total cost divided by total number of items. Of units, because this time we are using units, of units. So you take your total cost, you divide it by the total number of units, and that's how you find your average cost. That will be the cost that you are valuing your inventory with. So you are not going to use the 50, 60, 50, and so on. You are going to calculate your average cost every time. And it says that average cost should be calculated every time. Let me just write it. Average cost should be calculated every time you make a purchase. Okay, every time you buy inventory. So every time you buy, every time you purchase your inventory, you will need to calculate your new average cost. Every time you purchase your inventory, you will need to calculate your new average cost. Okay, so this meeting will end itself in 10 minutes time. So once it ends itself, I will reopen the class so we finish this activity, this question 2. Okay, so we have the date. The date, we're using the same information. It's January the 1st. So what did we do in January the 1st? What we did is we bought items, $100. At what price? At 50. So in the buying price, you record exactly what you bought. It was 100 units at the price of 50. Okay, so you did not issue out anything. So what will be your new balance? We said that it's total cost divided by total units. So what is the total cost of this? Obviously, the total cost, you find it by multiplying your number of items multiplied by their cost per unit. So 100 times 50 will give you 5,000. Ne? So if you take your 5,000, you divide it by the 100 units. So obviously, in this case, you will get only 50. That's why you will have 100 at 50 units, which is the average cost. So basically, the first transaction is always the same in all methods. The first transaction is always the same on both methods, unless there is a balance brought down, then it will be different. But if there is no balance brought down, then the first recording will always be the same in all the methods. And then we move on to February. So what did we do in February? In February, we sold. So we have Feb. This question was very much easy because it was too straightforward. Ne? There were not trick parts in this question. So we did not buy anything, but we sold. How many? We sold 40 units. At what price? You use now the price that is here. Your new average cost is the one that you use. So 40 units at the price of $50, and then you are left with 60 at the price of $50. So what will be your new your new total? It will be 3,000. Ne? So still is the same. There is no difference. So the difference will come from March. So what did we do in March? So in March the 10th, what did we do in March the 10th? We bought 120 units at the price of $60. Do you understand? So we did not issue out anything. So what we need to do now is, we do not, when it comes to AVCO, we do not bring down the balance anymore. You just add all the items together, then you get their average cost. So let's calculate our average cost now. So our average cost will be the 60 units, your previous balance, which is 60 times 50 plus the one that you bought currently, 120 times 60. Ne? That will give you how much? Then it will give you 10,200. Ne? So 10,200 is your total cost. Total cost is the cost of the previous month balance. This balance that you still have, remember, you still have these 60 items in stock, so you cannot leave them behind. So this balance of the 60 items, and then the balance of the new items, you add the two totals together, total values together, then you get your total cost price, your total cost, and then you divide it by the number of items. So how many items do we have in this case? We have 120 items plus 60 items. That will give us how much? 120 plus 60, that will give us 180 units. Therefore, you divide it by 180, and then you get your average cost. So 10,200 divided by 180, and then you get your average cost of 56.67 cents. 56.67 cents. And we say that because we are dealing with money, you always round off to 2 decimal places. So if you calculate, if you are following and you are calculating, you will get 56.6666 with a lot of 6 and 7. So you round off the two decimal places because it's money. So you will have 180 units at the price of 56.67. Do you understand? Their average cost, 56.67. That is the average cost. So you add your units together, your previous units, previous month units 60, and the current units 120. That will give you 180. Then you find their average cost. Then you value them according to their average cost. So 180 times 56.67, that will give you how much? Then it will give you 10,200.60 cents. Okay. And then from there, you move on to October. You move on to October. So what did we do in October? In October, we did not buy, but we sold how many units? We sold 60 units. So we sold 60 units at what price? At the average, new average cost that we calculated. So it will be 60 at 56.67. So what will be our new balance? So 180 minus 60 will give us a total of 120. So 120 units are left at the price of 56.67. Okay, I hope we understand. Okay, and then from there, sorry, this is 120. And then from there, what we do is we find our new total. So 120 multiplied by 56.67. That will give us how much? It will give us 6,800. 6,800 point, it's 0.40 cents. Okay, so we move on to our November, month of November. So what did we do in November? We did not buy, but we issued. We issued how many? 20 units at the same cost, at the cost of the previous month, which is 56. Previous month balance, which is still 56.67. It has not changed because we did not buy. So the cost only changes if we buy. So this cost only changes when we buy. It says average cost should be calculated every time you purchase inventory. Now in this case, we did not purchase, but we just bought. But we only sold. Okay, so how many are left? We only have 100 units at the price of 56.67. So what is our new closing stock? So 100 times 56.67, then you get 5,667. That is your closing stock that you are looking for. So the class will end itself anytime soon. So once I reopen it, then you can ask questions if you have any questions. Once I reopen it again.